One of the key questions you need to ask as a business owner is what financial information should I be getting and how frequently should I be getting it? So in this video, we're going to look at all the different elements of what you should be receiving and how frequently you should be receiving them. So there's 3 elements to any good finance team in terms of their financial reporting. There's looking back, there's projecting forward, and then there's ad hoc reporting. So let's break down each of those elements. Firstly, there's the rear vision mirror, there's the looking back. So this information you should receive once a month. And as we've spoken about in other videos, it needs to be accurate, it needs to be timely so you can make informed business decisions. So number 1 is your balance sheet. You might go, profit and loss, don't I want to know how much money I did or didn't make? No, you need your balance sheet first because this will tell you if your P&L is going to be accurate. And if you're working with your finance team and having constant conversations with them around your personal education in finance and also the information that's showing on your balance sheet, will then mean that you can have greater confidence in your profit and loss. One of the biggest challenges we see is people who don't trust their profit and loss. So on your balance sheet, you're going to have your assets, your liabilities, and the difference between those will either be equity or negative equity. Ideally, it's equity, but you need your balance sheet once a month. Then from there, you're going to get your profit and loss. So your revenue minus your expenses giving you your profit. And yes, there's a lot more elements that go into your profit and loss, but just for this video, your profit and loss, revenue minus expenses, hopefully equals a profit rather than a loss. So they're 2 common ones that you'll get, and more often than not, regardless of what finance system you're using, you can just click a button and go, yeah, here's my balance sheet, here's my profit and loss. The next few reports is when you're starting to get into the upper echelons of real financial mastery within your business. The next financial report is your cash flow statement. And one of the phrases I love to say is you can't fake cash, because you could potentially get someone like myself, not that I would recommend doing this, and fudging your numbers on your balance sheet and fudging your numbers on your P&L to make things look better than what they actually are. But the thing that can't be faked is cash. Unless I'm going to get a photocopier and start photocopying money, A, I'm going to end up in jail, and B, it's probably going to get caught as counterfeit anyway. So the cash flow statement, the key element there is understanding where has my cash gone, because your profit and loss might look really good for the month, but the money might be still sitting in your client's pockets. They might not have yet paid it, or your stock might have gone up, or you had to pay a large tax bill. Your cash flow statement is going to tell you where the money's come in from and also where the money's gone out to. So your cash flow statement. Number 4 is looking at your KPIs, so key performance indicators. And we've got videos that go into a lot of detail around what KPIs you should be tracking and also templates you can use to understand how you're performing relative to different benchmarks. But in those KPIs, you need these core elements. 1, you need a history of data. You need a history of data of how you've gone in good times, how you've gone in bad times, and how you're going today. So in that way, you can understand where you're sitting today relative to previous parts in your business history. So for example, if your gross profit percentage is 35%, how does that look in comparison to the same time last year, to last month, to 3 years ago? Is it tracking upwards? Is it trending downwards, or is it plateauing? You need to understand these things from your key performance indicators. And there's at least a dozen core elements that you need to have to understand within your business's KPIs. The next one is looking at how you went versus budget. So ideally you have a budget report that you can compare to. So we were aiming for $100 in revenue and we did $95, so it's a sad face. Or we were aiming for $100 in revenue, we did $105, crack open the champagne, we did an awesome job. Looking at all the different elements, because we want to understand what things did worse than what we expected, what things did better than what we expected, but most importantly, understanding why. Is it because we employed 3 more people than what we anticipated? Is it because we did a big project that incurred greater costs, but also it helped us get greater revenue? So the budget is a really good place to reference information of how I thought I was going to go versus what we ended up doing. Now, one step further to that, and we'll talk about this when we do the looking forward exercise in a moment, is also comparing to your projections. So ideally what you have is you have a budget that you set at the start of the financial year, and that stays fixed. But then you have projections that you do each and every month of how do you think we're going to go over the next 3, 6, maybe even 12 months. But most places will look at the next 3 to 6 months of how they're going to perform and looking at how we compared to our projections with what we actually did. Now, the thing with the projections is there's a better chance you'll have those more accurate in comparison to a budget because the time frame you're looking at is a lot closer than what you might have done when you set up your budgets. So quick recap. With your rear viewing reporting, try saying that quickly, you want to get this once a month, you want it timely, you want it accurate, and you want to make sure you can use that for business decision making and learning. So the reason we look back is to learn, and that comes from balance sheet, profit and loss, cash flow, KPIs, and then budget and ideally projection comparison. So the only reason we look back is to learn. And that's not designed to sound like a life coach. That is how finance teams are meant to work. You look backwards to learn. So we receive the rear-facing reporting once a month. Then at the same time, we want to project forward. What do we anticipate doing over the next 3 months, over the next 6 months, over the next 12 months? So for example, a construction company might have a good idea of what its pipeline is going to look like or potentially could look like over, say, the next 6 months. For a retail business, it might only know what it's going to look like with any meaningfulness over the next, say, 3 months. Whatever is appropriate for your business, you want to be able to look at your projections and understand where you're going to be going before you get there. So that way you can identify potential challenges. How's our cash going to look? Are we going to need more stock? What are the constraints we're going to have within our business? But also on the flip side, there might be opportunities that we could capitalize on. So having a good set of projections and accurate projections will allow us to take advantage of opportunities and potentially mitigate risks or weaknesses that could be coming up if we weren't aware of them. So the projections are key. So we look back to learn and we look forward to influence. We look forward at our projections to influence what is coming up. And when you've learned from the past and can see the future, you can influence it and impact it. The cliche I love to use is, I don't really have a fear of flying, so long as they're jets and not propellers, is that when you're on the plane, sitting on the ground and the pilot goes, we're flying from here to there today, and about half an hour after we take off, I'm expecting a bit of turbulence. And you get half an hour in your flight and there's a bit of turbulence. I'm not worried because the pilot knew that was coming when we're on the ground. Where I get nervous is there's no pre-warning and then your plane gets buffeted from side to side. Your projections are the pilot looking for turbulence ahead, but also he or she who's flying the plane is also looking for the clearest path to get you there as quickly as safely as possible. And it's the same thing with your business finances. So the third and final part of your financial reporting is ad hoc reporting. Now, ad hoc, yes, it's a catch-all phrase. But the purpose around ad hoc reporting is in finance, you have very definitive timelines around monthly reporting, and that's what ideally you should be getting from your finance team. The looking back and the looking forward. But what about during the course of the month? How do you know how we're performing during the course of the month? So one of the, dare I say, obvious ones is sales reports. You want to understand how much or what volume of sales you had during a day. And that's quite often a key benchmark in just about any business, is what their sales are in the day. The reason being, if you look at other elements that make up your financial reporting, let's say your wages or your material costs, it might not be easy to pick up on trends on that on a daily basis. But I'm going to let you in on what the elite business owners do on an ad hoc basis. And an ad hoc basis is a flimsy way of saying they do this daily. So I'm going to give you 2 numbers that you need to track. The first one is not sales, it's actually gross profit. How much gross profit dollars did I generate today? and what is the percentage of gross profit. So quick recap, gross profit is revenue minus our direct costs. So the direct costs are the elements that go in directly to producing our product or our service. So if I was to say to you, Miss or Mr. Business Owner, you've done $100,000 sales today, is that good or bad? Well, my next question is, how much gross profit did I generate from those $100,000 worth of sales? If on Monday I did $100,000 worth of sales and did $70,000 worth of GP, but then the next day I did $100,000 worth of sales, did I have just as good a day as the day before? If I did $60,000 worth of GP, I actually had a worse day on that second day than the first day. GP should be absolutely celebrated as the number that you protect more than anything else in your business. Because remember from previous videos, what do I say are the core elements to business success? Sales and marketing, gross profit, and working capital. Gross profit is that number 2 element in that equation. And then the second part of the ad hoc reports that you need, that the elite business owners get, is understanding how your gross profit translates to break even. So if your gross profit to break even each month is, let's say, $500,000 or $50,000, and you've got 20 trading days in the month, they know exactly how much gross profit they need to generate in each of those days to make sure that they're breaking even. So you might be asking, why do I want to look at break even? I'm not in business to break even, I'm in business to make a profit. Well, if you understand how far you are above break even or below break even on any day, you can really motivate and influence the team rather than wait till end of month, you get the reporting and you go, oh, this month kind of sucked. So you want to make sure that you can influence that behavior immediately within your performance of your team. So to recap, what financial information you must get and how often you get it. So rear vision mirror, balance sheet, P&L, cash flow, KPIs, and then comparison to budget, and also ideally your projections. And you're getting that once a month as quickly as possible and as accurate as possible after month end. Then at the same time, you're getting your projections forward. What do you expect to do over the next 3-6 months so that you can influence that behavior? So rear vision is for learning, looking forward is for influencing and improving. And then the third element is my day-to-day, my ad hoc reporting that I should be getting from my finance team. It's looking at sales, number 1, but to be elite, getting gross profit reporting per day, and how does my gross profit compare to what my break even needs to be? If you can drive your finance team on that, then you'll be well on your way to being in the business elite.